Ashish Saumaiya is now joining in on the show from Motilal Oswal. He is the MD and CEO. Good to have you on board, Ashish. Good morning. And as we're getting accustomed to this new reality, the markets seem to be clearly ignoring the economic repercussions and holding out quite smartly. But you believe that this rally can't really be taken for granted?
Yeah, I would definitely say it can't be taken for granted. The reason being that, if you actually look at things quite closely, till now we have only been tracking the broad international scenario. I mean, if you go back a little bit in time, on 23rd of March, for example, before the lockdown was announced and before COVID even became a serious issue, we were 40% down. And as COVID has progressed and the lockdown has got stretched into the third month, we are actually 25% up. So, well about 25%. So my sense is that, till now, I think we've been tracking flows, broadly speaking. But as we get into July, August, and September, and a lot of data and numbers flow in, maybe that's the time to see whether we've overdone some of the things or whether we've underdone and where the economic realities actually lie.
Oh, yes, indeed. What about the move that you're seeing from the broader markets? Because there has been quite a catch-up play and outperformance as well, you could say. Are you being very selective when it comes to picking out stocks within the mid-caps? Because you have also seen that despite the volatility, some of them have been unscathed. They are managing to hold out quite smartly. Or do you think that rude adjustment or shock is going to be the order of the day?
No, I think that even if one says adjustment, or even if what I said about the economic realities, obviously we all know that it applies differently to different stocks and different sectors. I think that first, when there is panic, the kind of panic which we saw in March 2020, I think when there is panic, investors in general lose the ability to differentiate or to be discerning in nature. So first there was panic, and then there was a bit of a what you call a reversal in the positive direction. So for the panic also has been broad brush, and I would say largely speaking, barring some banking stocks, etc., largely speaking, the reversal also has been fairly broad. But I think from here on, like you rightly pointed out, from here on, I think things have to get a bit more selective and a bit more choosy. So even if you look at emerging markets as a broad brush, within that, if you look at countries and sectors, and within sectors, if you look at stocks, I think everything has to get a bit more picky and selective as we move into the next quarter. That's how I would see it.
Okay, fair enough. When we're looking at going incredibly stock specific, Ashish, guide us in the right direction as to where you feel perhaps valuations are still looking reasonably attractive, or where you feel we're going to still survive any highs and lows that come along.
Yeah, I would tend to believe that, say, for example, autos as a sector, that is something which is, whether it is COVID or pre-COVID, April and May, the sales are quite disastrous. I'm sure that this is not something which we've ever seen in history. But barring that, still, if you look at it closely, pre-COVID also it was a sector which was quite in pain, and it continues to be so. So, pun intended, it's like a slow-moving car crash as far as auto is concerned, because it's not like they were coming off some historic high growth or any of those kind of scenarios. Right from 2018, it has been a troubled sector. And my sense is that as we get out of this particular tunnel, that is one of the things which will actually tend to see a pickup. Even the early signs do seem to suggest that, quite selectively though. Also, a lot of auto, at least in the passenger vehicle segment, a lot of it depends on financing. And my sense is that when we are on the other side of the tunnel, liquidity will prevail and interest rates will be low. And of course, banks will have to, wherever possible, selectively, they'll have to resume normalcy. So my sense is a lot of things which depend on availability of finance and interest rates, and whatever is deemed to be relatively safer or secure in terms of lending, some of those things will get some support. That's how I would put it. So everything which is to do with auto and consumer discretionary on a selective basis, that is how I would put it. Pharmaceuticals, selectively, I mean, not to see it as a broad brush sector, but selectively that continues. Insurance, for example, that continues, because right now everything to do with BFSI is seen as BFSI. And I actually have seen that, for example, in our portfolios, we had BFSI exposure, but a very, very significant chunk of that has been insurance. And in the last few weeks, I have had to explain to a lot of investors that don't look at BFSI as broad brush. At least one needs to see what is lending financials and non-lending financials. So I think capital market companies, I think insurance companies, they are in BFSI, but then it's a completely different set of parameters, which is likely to drive their penetration moving forward. So these are just some examples, but I think that there is value to be picked in some of these places.
Nice. That's actually quite an extensive list that you've shared with us. Let me reverse that question. What would be a clear avoid?
See, I think that at Motilal Oswal, we actually, whatever fits for us, whatever fits into growth orientation, whatever fits into relatively more sustainable growth, that is what we want to look at. And hence, frankly, not from just a current market scenario, but generally speaking, we have avoided, if you see our portfolios, irrespective of our quest for returns, we generally avoid anything which is leveraged. So anything which has, and that is something which in the current, we are not out of this tunnel right now. So anything which is leveraged, anything which is heavily cyclical or geared to the global economy, one has to be careful. One has to be wary about those things. And again, I would qualify my statement by saying that this is our belief for all times, not just for this COVID-19 related scenario. So that bit of risk aversion has always been there, and that continues. And the other important thing is that anything which is very heavily linked to investments, the investing side of the economy, I think there the confidence and government finances will take some time to get back in shape, because that also will be very, very selective. So this is something which we are actually staying away from right now. And of course, we have to calibrate positions as we go along.